Hi, I'm Justin, and welcome to the Landis Look, where we take an inside look at the world of real estate. Today, we have a guest, Mark Dacre with Ameris Bank. Mark, thanks for being here.
Thanks. Pleasure to be here.
Mark is #1 lender in the state of Georgia, and he's going to share some mortgage knowledge with us today. And we're going to take a look at different types of loans. So a lot of you probably know that the most common type is a 30-year fixed mortgage, meaning it's 30 years long, fixed rate. But there's also 15-year fixed, there's ARMs, adjustable rate mortgages, and Mark's going to kind of break down some of the highlights of these and why you might consider those. So, maybe at the very beginning, is there a reason that 30-year fixed is like the most common, or, even if you would call it industry norm?
Yeah.
How did that happen? Do you know why?
That's a great question. I don't know the complete origin of it. I would say that when you look at a 30-year amortization schedule, it allows you to do a couple things. It allows you to basically minimize the payment over the longest period of time, but still make a meaningful principal payment to pay the loan off. So what happens is if you go to a 40-year amortization, let's say, you're almost paying pure interest at the beginning of that for quite a while in order to amortize a loan out that long, over 40 years. So probably at some point someone sat down and said, what's the minimum payment we can get customers in and still have them making some sort of meaningful principal payment to pay it off?
Because the minimum payment allows people to afford it, right? It's basically like, hey, I can afford this payment. But if you had a 50-year amortization, after 10 years, you've paid basically nothing down except for you're just paying interest.
You're just paying interest. So had they come up with a 50-year loan, it would have been similar to interest-only loans for quite a while at that point.
So obviously on a 15-year loan, you're paying the loan off in 15 years versus 30 years. But how else do those loans compare from are the interest rates different for those two loans? And what does that, look like for a borrower who's considering between those two?
Yeah. So the interest rates on average are going to be about 3/8 to maybe a half point lower on 15-year fixed loans.
Okay.
It's borderline a meaningful difference. It is a difference, and it is worth saving. What I generally will tell people is, if in your budget, the 15-year payment is barely even noteworthy, or it's barely even a budget item for you, you should always do a 15-year loan, because the 15-year loan is enough interest savings to justify it. If it's creating a budget issue for you or a lifestyle issue, then the interest rate savings alone is not worthwhile doing it. Because if it's creating an actual budgeting issue for you, there's a good chance you're probably going to take on some other debt to now afford your 15-year versus a 30-year loan. And that other debt is almost always going to be more expensive than mortgage debt. So if the 15-year doesn't make a difference at all and you can pay on it, great. By all means, do it. Save the interest. But I would say that's about the only reason that the interest by itself is a compelling reason to do that.
Okay. Let me throw this one at you, because I've heard this from folks who've said, my financial planner said to take the 30-year loan and invest what you were going to put into that additional, because you can get a better return. How would you answer that question? And do you think that that's potentially a good strategy for some folks?
Yeah, I'd say that advice runs fairly parallel to what I just said. So I think what the financial advisor in essence is saying is, look, the 30-year versus 15-year rate savings are not that substantial. Right. So to save a quarter, 3/8, in theory, you should be able to make that up in the market with well-invested assets. So in that case, if you can afford the 15-year payment, take the 30-year loan. The rate savings are not that substantial. Invest the difference. And if over time you've made up more than that 3/8 or half point, then there's fair reason to go ahead and have invested that money.
Yeah. Well, it also requires the discipline to actually invest the money, right? That's one of the things that I think about from the mortgage. It's a little bit of forced savings. You are, by paying the interest rate, you are getting that return essentially, right? And so it's like, hey, I signed myself up for the 15-year payment. I know that there's little chance that I'm going to go spend that money on vacation and not actually invest it in the market.
That's right.
Because it's coming out each month. Is that kind of...
It is a function of the discipline, for sure. If for whatever reason you find yourself spending that money instead of investing it, and you could have done the 15-year otherwise, then a big case to be made for that, for sure, for having just taken the 15-year. You know you can count on it. And the great thing about reducing debt is that is a guaranteed rate of return by you not paying that interest rate. So it's hard to find guaranteed rates of return otherwise, even at a small number. So to avoid debt is to get that guaranteed rate of return by not paying debt on it.
And I'll tell you all, just personally, from doing this with our loans to have them on 15 years, it just feels good to see the payment come out of each month, and you're like, wow, there was actually a lot of principal that came out of that, versus I mean, even on the 30-year, we were talking about 40 or 50, but even on the 30-year, those first couple of payments, not a ton of principal is coming out. And when you do have it on the 15, you're like, man, that's really great.
Yeah.
So let's take a look now at an adjustable rate mortgage, an ARM. So first of all, how does an adjustable rate mortgage work? And then we'll get into why someone would consider that.
Yeah.
So what is an adjustable rate mortgage?
An adjustable rate simply means that there is some fixed period of the loan. So the rate cannot change for an initial period. And then after that period, the rate can begin to adjust. Generally, it has some sort of caps or limits on how much it can adjust. So you'll commonly hear people refer to a 5-1 or 7-1 ARM, 10-1 ARM. All that period means 5-1, 7-1 is that in a 5-1 ARM, the rate is fixed for the first 5 years. So that rate can absolutely not change. It functions the same as a 30-year fixed loan. After the 5th year, that rate can then begin to adjust once per year. So that's the one part of the 5-1 ARM. So your rate is not going to change monthly or daily or anything like that. It'll change once per year at the anniversary of the loan at the end of the 5th year. And then every year thereafter, it can continue to adjust.
And what's it adjust based on?
So there is some sort of index that when you take an ARM, the rate is based on. The popular one is the LIBOR. So what will happen is it'll be based on whatever that indexed rate is at that time. So they'll go ahead and say on the 5-1 ARM, look at the end of the 5th year, say here's the LIBOR rate. They'll use that as your index, plus there's generally some sort of margin that makes up the total interest rate at that time, and they'll calculate a new interest rate.
How is the initial interest rate? So say I was considering a 5-1, how is that initial interest rate compared to the 30-year fixed interest rate currently?
Yeah, so right now we have a good deal of rate compression. And what that means is that because the 30-year fixed rates have gotten so low, that there's not much of a gap between that and ARM rates. Okay. So there's not nearly the compelling reason to take an ARM there might be in a higher interest rate environment.
Because that hasn't always been the case, right?
Hasn't always been the case, no. So as rates generally tend to get back to an all-time low or close to it, there's only so low those ARM rates will go. There's more or less kind of a bottom to them. So at that point, you have interest rate compression between those two loans, and so the gap may only be a 0.5 point or 3/4, whereas in higher rate environments, that gap has been 1 point, 2 points or more.
Okay. Which makes a huge difference on the payment.
Yeah, absolutely.
So why do people consider or elect to go with an ARM versus a fixed rate?
Yeah. So the only benefit to the ARM in most instances is the interest rate savings. Okay. So if you knew you were going to be in a home for 5 years or less, and even if the savings were only 0.1% on the interest rate, you might as well save that 0.1% if you knew you were only going to be in this loan for 5 years or less or 7 years or less. But because most people don't know that definitively, the benefit of 0.1% would be almost immaterial to say this is worth taking the risk that this rate could go up 5 years from now, especially relative to the interest rate environment we're in right now.
Right. Because interest rates now near an all-time low, so the likelihood that in year 6 they're going to be lower now and it's going to adjust down, really unlikely, right?
Or even close to the same.
Yeah.
I mean, if you were going to play it out and they were close to the same or in the same ballpark, then it worked out okay for you, but it's not something you can bank on.
Yeah. So this would be a case of, say, for example, maybe I was coming to Emory to do a fellowship and I knew it was 4 years and it was really unlikely I was going to actually practice in that, practice in Atlanta afterwards. So I'd almost certainly be selling at that point. That's the kind of situation where this could make some sense for?
Absolutely. Regular career movers, people who know maybe they're just in school here and maybe one spouse works and they're going to move back to their hometown at the end of this, save the money. On the flip side, though, a lot of people end up wanting to rent that home
house
later. And they're like, oh, goodness, I wish I would have just got a 30-year fixed rate, because renting it is the same principles in terms of the interest rate moving and the benefits of a 30-year fixed.
Yep, definitely. So let's take one other end. This, I feel like, used to be, before the crash, a pretty common type of loan, but I don't hear it talked about a lot now. What about interest-only loans?
Yeah.
So, I mean, it is just interest only is what you're paying. That's right. Why were those popular, and do you see them very much now, and why do people elect for those?
Yeah. Interest-only loans were really popular back then, and I think there were two compelling reasons back then. One, the interest rate on an interest-only loan was basically pretty close to the same rate as you could get on a comparable loan. So if you had a 30-year fixed interest-only and a 30-year fixed regularly amortizing loan, you were getting pretty much the same interest rate back then. Okay. Same thing, 7-1 ARM, 7-1 interest-only, pretty much the same interest rate. So there wasn't a great drawback to going with that loan at that time. The second benefit is it allows you to really control any sort of principal payments you'd make on the loan and determine, am I better off investing this money? Am I better off doing something else with it, maybe paying off other debt versus paying down my mortgage? For some people, that's a reasonable case to be made. If you're going to buy a home and you have credit card debt or higher rate debt, you would be better off in most cases taking an interest-only loan and applying those funds towards that other debt. The reason they're almost non-existent now, and you really don't hear about them, is because the comparable mortgage is no longer more or less the same interest rate at this point. So to get an interest only is maybe anywhere from a quarter to a half point more, but that's on your entire debt. So now we're talking about a half point more on $200,000, $400,000. It's a harder case to make, and they're also really hard to find. They're very rare mortgages.
Yeah, and so these are the type things that you help people look at their situation and then figure out what's best for them. Because I mean, I assume the answer is there's not one type of loan that's best for every single person, right?
Not at all, and that functions in so many ways. In the area of down payment, in the area of should they have PMI, should they not have PMI, how should we structure the loan in terms of who's paying the closing cost, the lender, the seller, all of those things need to be considered.
Yeah. So if you heard this today and you're like, man, that's good information, seems like I need to get some more info or talk to someone about it or understand my personal situation, Mark can definitely do that for you. Just drop us a note here below or send us a message like a lot of y'all do, and we'll get you connected with Mark so you can get all those questions answered. We appreciate y'all listening today. We'll be back next week and we'll see you then.